Apollo Capital and Securities joins us. Sandeep, morning. Thanks for joining us. Prashant this side. A quick comment, if you will, on the way we've rallied on 25% from the lows. We're just around the corner as far as the third quarter results go. Do you think there's a little bit more once the numbers really do come out? That's the time we'll see some sort of a sell-off?
Hi, morning, Prashant. Yes, to a certain extent, we saw the lows in October and about almost 2.5–3 months of rally. We need to look at the time frame, and the only analogy that we can draw at this point in time is if you look at the 1929 crash in the US markets. After having, we are following exactly the same pattern up to now, and as far as the pattern suggests that we should see a sell-off in mid-January. And as far as the numbers are concerned, I think the street has still not priced in. When the last time when I was here in November, we talked about not about growth in profit numbers, but instead that the companies may actually show decline. I mean, there will always be pockets of strength where some specific companies will show growth. But if you were to look at the collective earnings of top 100 companies, we think as a house that there will be a decline in earnings. So I think there's a slight, there will be a slight expectation mismatch as we come into the earnings season.
Sandeep, what's your strategy for the market? How will you play this market from here on? The RBI and the fiscal stimulus package has come out. You could perhaps argue and say that it's done quite a bit now. If you combine both sets of measures, the early ones which were announced in December and the latest ones combined, they will have some sort of a positive impact in the coming months. Will you look at specific sectors which have been targeted via these packages? Automobiles, for example, which have been untouched by the market, not in favor. Real estate, infrastructure, perhaps even some of the banks out there.
Yes, I mean, talking about the stimulus package, the package number 1 and 2. First, I mean, in terms of monetary steps which the RBI has taken, I mean, we are almost now in sync with the global central banks. So earlier we were behind the curve. Now I think we are very much in line. Now, talking about the stimulus package, the measures which the government has taken, we are not very impressed by the measures, primarily because there's nothing that stimulates demand. So most of the, if you talk about the auto sector, I mean, gone are the days and where you just lower the interest rates and you start expecting growth in return. I mean, if that were the case, then you would never see recession anytime. So the auto sector still, accelerated depreciation which has come out in the second stimulus package. I mean, that's not a great incentive for anybody to go and start buying trucks or commercial vehicles, because the demand side is not taken care of. I mean, there are so many the fleet operators where the 20% of the fleet is lying idle. So just because of accelerated depreciation, and that is valid for just 3 months, it doesn't really give any incentive for anyone to go ahead and buy it. Real estate, interest rates for up to 20 lakhs, interest rates have been lowered. But it remains to be seen to what extent do banks actually pass it down to the end consumer. Just to give you an example, that we have seen close in the US, the Fed has reduced rates to almost 0. The same is the case. I mean, in the UK, it's close to almost 1.5%, which they are planning to reduce it to 0. But if you look at housing loan interest rates over there, they are way above 5%, where the lenders are refusing to actually pass it down. And we can see a similar scenario here, because no lending institution can actually start risking its portfolio just because interest rates are down and not looking at the credit risk of the individual customers or say corporate customers. So in this scenario, people who got a very good credit rating, only they would be able to avail loans. So real estate may not see the kind of rise or in prices or the uptick which the stimulus package may have been aimed for. I think we are in for a very rough ride throughout the whole year.
But
and as far as the banks are concerned, yes, PSU banks. Sorry.
Right. Continue. Sorry.
The PSU banks will benefit we've had a buy for the PSU banks for almost 1.5 months, 2 months now. In this scenario, primarily because they will end up taking up more market share from the private lenders because of the lower interest rates which they are offering. I mean, a similar situation was there in year 2000, 2001. So yes, it's quite positive for the PSU banks.
Sandeep, not getting sector specific, but just talking about this lending environment right now. With yields now at record lows, there is a notional loss attached to banks investing in bonds, which they've been doing as hedging their risk attached. So there seems to be a very, very visible case building up that they will have to go ahead and lend, and therefore cut deposit and lending rates and lend out this money. I can understand the sensitivity of sectors like real estate, but for the broader economy, we should see a significant amount of lending happening.
Ideally, and I mean, theory-wise, what you're saying is correct, but in practice, to what extent it's followed, it remains to be seen. We are seeing banks globally, be it India or be it anywhere else, the lending is drying up and it's still not picked up. It's, as I said, the credit risk is the biggest issue. So banks, it's a very difficult situation for banks whether they should go out and lend to people when they fear that the money will not be returned. So they need to strike a balance, and it remains to be seen. As I said, just because the environment is so tough and it's unprecedented that, just because we lower the interest rate, it doesn't necessarily mean that the credit offtake will start to increase. So I think we need to see this. I'm not in a position to say very confidently, yes, the credit offtake will increase. I doubt that.
What about the flow of FIs as well into this market? Because the rate cutting measures seem to have prompted a degree of confidence returning into FIs' minds. So we've seen a bit of inflows over the last 2 weeks, Sandeep. And then, of course, you have the currency as well, which has strengthened, which has been a problem spot, especially for India in 2008.
The FI flows has definitely been positive, but as we have as the year has ended 2008, so we see that a lot of redemption pressures which were there earlier they are not there anymore. So institutions who are flush with cash, they have started to put in money, and I think the trickle can start to increase from here, but we need to see, as we are in the earnings season, people need to see and figure out to what extent. Most of the earnings that people are saying that, well, it's already discounted, but to what extent the slowdown will be there. Some people are saying 6 months, but our opinion is like, well, we won't see recovery till late 2009. So if that's the case, then expectations build up, people start buying, and when that doesn't happen, then the sell-off continues. So we may be range bound. Market's not going to go very high. It may react to a certain extent, but as I said, it remains to be seen.
All right, Sandeep, thanks for joining us as always and giving us your thoughts and perspective on what to expect from here on. We'll take a quick commercial break as well, come back, and we'll be, of course, getting you ICICI Securities' view on what to expect in trade today. That's coming up after this break.